Hey, good afternoon, everyone. Thanks for coming and attending the webinar. And really, what we're going to talk about today is we're going to go over some of the topics we discuss in our trading school. And remember that this is that day trading is really an endeavor in which supposedly 90 to 95% of everybody fails. And I think that the reason that happens is because there's a fundamental flaw in the way that everyone is taught how to trade, or most people are taught how to trade. And people who break through this flaw wind up actually day trading profitably, as we do here at Rightline. And really what I want to discuss are some of the things that you have to work through in order to get to where you want to be. And that's really, first of all, it's going to be to ignore 99% of the stuff that you're taught and really take a different approach to the markets and the way that you day trade. Now, first, a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years, and I began trading the futures and Forex markets about 10 years ago. And I was involved in the optimization of software systems for the last 10 years via mathematical modeling. And essentially what we do here at Rightline is we look at the market and we look at market movement by breaking it down into a series of independent variables. And those independent variables comprise an equation. And by optimizing the equation, by changing each independent variable, we ultimately come up with a formula by which we can accurately predict the future direction of price movement. Now, I think the only thing that's really important about this slide is, many vendors do ask you to buy software or buy trading techniques that you cannot see until after you buy them, which obviously is not a great idea. But essentially, they come with back-tested strategies and entries with no mathematically quantified predictive value. And what you want to know anytime you purchase software of any kind is what is the sensitivity, what is the specificity, and what is the positive predictive value of a trading entry. Now, I've asked many software salesmen in many webinars what these numbers are, and I have yet to be given an answer. And the reason is because nobody knows them. And unless these numbers are known, they cannot in any way proffer to you that the software is successful. We understand the sensitivity, specificity, and positive predictive value of everything that we do. The important thing is that positive predictive value determines outcome. If there's a high positive predictive value, if the chance of taking an entry has a positive predictive value, say of 85%, 85% of your trades will be successful. But in order to get there, there's one additional parameter besides sensitivity and specificity, and that is prevalence. In other words, you have to take a trade in which a predefined series of independent variables determine that the market is not in chop. And you'd be surprised how difficult that variable is sometimes to determine. People define chop in many different ways. Now you can understand that the prevalence of a successful trade during chop is going to be much lower than the prevalence of a successful trade when the market is trending. So how exactly do you determine whether the market is in chop or whether the market is trending. And although that may seem a simple question, it's not. And I'm going to show you that the only way to do that is by understanding how to interpret price action and market structure. Now, this is the most difficult part of day trading and the part that most people skip because it's difficult to master. It takes a lot of work. And what the easy way to go is simply to trade indicator signals. Now, if you trade indicator signals, I'm telling you, you're guaranteed to fail. Indicator signals are meant to be looked at to verify appropriate price action market structure areas to increase the predictive value of an entry, i.e., market structure and price action determine that you're not in an area of chop, that you have ascertained a good entry based on market structure and price action. And then indicator analysis is simply used to verify that that's a great trade to take. So again, other systems have no track record and many systems are just plain broken. Now, I'm going to skip this a little bit because this is just an oscillator, a stochastic, which is an oscillator. Now look what happens if you wind up trading an oscillator. People trade oscillators in different ways. When the market is overbought, some people will say, okay, well, the market's overbought, bulls are firmly in control, and I'm going to continue to buy as long as price continues to move through each pivot. As each high pivot's broken, these people will continue to buy the market. Other people do just the opposite, other traders. They look for divergence. When price makes a higher high and stochastic makes a lower high, they look for the price to fall. And they'll sell here. And you can see how often that this fails. So if you try to trade an indicator signal, if you add a MACD to this, you may increase the predictive value of the entry somewhat, but it is not going to be nearly enough to get you to where you want to be. Not even close. Now, people label indicators all kinds of really fancy things. I mean, I saw one that was called the four-dimensional indicator, and all kinds of crazy names. But there are only 5 variables on your chart that can be crunched through a formula that ultimately traces out a line that you use to trade. And that is the high of a candle, the low of a candle, the open of a candle, the close of a candle, and volume. Now, I shouldn't say candle. It can be any formation, and a formation is an open, high, low, close bar. It's a candlestick. It's a Renko. Whatever you choose to look at the market, whatever formation you use to trace out a period, is going to have those 4 numbers, or those 4 variables, including volume. Now, the problem with standard Renko is that there is no open high and close low. There's only the high of the Renko brick and the low of the Renko brick. So be very careful when trading Renkos and looking at what formula or what indicators you use to help you trade. Because a Renko is deficient in 2 numbers, and a formula like stochastic, whether it's relative strength, whether it's the CCI, whether it's fast stochastic, slow stochastic, requires open high-low close. So a Renko bar cannot be used with any stochastic. Now what we're going to do is look at just some of the another indicator that people use to trade with, and that is Fibonacci levels. Now I'm just showing you this because I want to compare and contrast with how most people are taught to trade versus the way you should trade, and the reason why 95% of traders fail and only 5% of traders trade profitably. And I just want to add parenthetically that in the last 6 trading sessions in the trading room, in our live trading room with Chart Trader up, and projecting our net profit loss, we have had 6 profitable trading sessions. And we're up almost $2,000 for the month already after commissions have been subtracted out. Now, the reason we do it, and I do the trading in the room, I am not a genius. Anybody can do what I do. You just have to have the basic fundamental understanding of the market the way I do. And it is not hard. It's not hard to get there. Now, if you look at Fibonacci extensions or look at Fibonacci extensions, you can see that sometimes they break and sometimes they hold. If you look at Fibonacci confluences, it's the same thing. They sometimes break and they sometimes hold. Now, if that's the case, and they don't hold 95% of the time, or if they don't hold a very high percentage of the time, then the predictive value of taking a trade off of a fib level becomes very, very low. And in fact, the predictive value of trading fib levels in essence is 0 because they don't really increase the precision with which you trade. And just to give you a really quick, I don't want to lose anyone here. I mean, Fibonacci described these numbers, I think, in the 16th or 17th century, and they don't describe the motion or movement of anything. I mean, there are all kinds of sophisticated theories in quantum mechanics that describe the motion of subatomic particles. There's theories in physics that describe the motion of planets. But Fibonacci extensions and Fibonacci transformations do not describe the movement of anything in nature. They're just more of a curiosity. And he invented these numbers a long time before obviously the stock market was around. And I don't know anyone how anybody took the teleological leap of jumping with Fibonacci into trying to predict how the market moved. Now, as bad as GAN theory and Elliott wave theory is in predicting market movement, at least those were developed to specifically determine how price behaves. Fibonacci wasn't even thinking of the stock market. And what we did was we did a year of forward testing looking at Fibonacci extensions and Fibonacci retracement levels. And they had really very little predictive value. There was no way that you could use them to trade and even come close to being profitable. I don't know anybody that trades Fibonacci extensions or retracements and trades profitably. I mean, they're just a curiosity, and people, I don't know why they're so drawn to them. But for the last 100 years, people have loved Fibonacci levels, the last 50 in trading the stock market, yet they've never worked, and they never will work. And that's one thing about things that happen in the market that don't happen in any other human endeavor. If you put up a building via a blueprint and the building keeps falling down, you change the blueprint. But when 95% of traders continue to trade over and over again using the same theories and the same methodology and continue to fail, nobody asks themselves, what is the underlying problem? What's broken here? I mean, where can I find the right way to trade? People just continue to fall off that cliff like lemmings and continue to blow their accounts. And so it's really very unique. I'm just going to skip this. And I'm going to skip this because this is going into indicator analysis. I'm going to skip market profile. And what I'm going to do is I'm going to go to some slides now. Because really what we're going to discuss is price action and market structure. And this is the backbone of day trading. And this is the part of day trading that really takes a lot of work. And it's also the part of day trading that most people skip. And this is what we spend an enormous amount of time working on in trading school. So let me just move to the first slide. And I'm going to give you some definitions. And then I'm going to teach you some market structure and price action and some recurrent formations that you're going to see over and over again that are going to really help you with trading. Now, hopefully that's centered in your chart. And what I asked here is, where is the best place to sell the market short? Now, it doesn't matter what the market is. These are range bars, and it doesn't even matter what the candles are, or if we even use candles. The point is that we're using market structure and we're using price action here to determine where is the best place to sell the market short. Now you'll notice that we have no indicators. So let's make certain definitions. It takes two candles of the same color to define a trend. So anytime you get two reds in a row, you're in a downtrend. Anytime you get two greens in a row, you're in an uptrend. So we're not using any moving averages. We're using price action to define itself as direction and trend. And let's make a couple of other definitions. When the candle body here is either equal to or higher, can't use a pen, or equal to or lower, you can see that the red candle engulfs the green candle. And you can see that the candle body, the red candle body, is big. And that shows that there's a tremendous amount of selling power in this candle. And it totally engulfs the buyers in the previous candle. So that's, if I can write it, I'm just going to put number 1 because I can't do better. That's simply candlestick pattern number 1. It's not a formation or a tradable setup. It's just something that's going to help us trade. Now, setup number 2 is you can see that this red candle does not engulf the previous green candle, but at least 1/2 of the green candle is pierced by the red candle. And in candlestick dogma, we don't look at wicks, we only look at candle bodies. And this is known as a dark cloud cover. A dark cloud cover in Chinese candlestick dogma shows as much selling enthusiasm as an engulfing candle. You can also see that the candle is big. The candle body itself is almost 8 ticks in an 8 range chart. So there's a tremendous amount of selling power here in this dark cloud cover. And this is Candlestick Formation 2. Now, Candlestick Formation 3, we can use this area right here. It's the exact opposite of the dark cloud cover. It's a piercing candle. And this is when the up candle body pierces at least 1/2. It's very difficult to use this to draw, at least 1/2 of the body of the down candle. So you have a dark cloud cover to the downside and a piercing candle to the upside. And this is going to be Candlestick Formation number 3. Now, at right line, we try to make all of our entries, we try to make the entry candles either to the downside, a dark cloud cover, to the upside, a piercing candle, or to the down or upside. In this particular case, it's obviously engulfing to the downside, or if it engulfs to the upside, like it does here, you've got a long move. You have a potential long move. So now what we've done now is we've created certain candlestick formations that we need to trigger a trade. And by doing this, what we're doing is we're creating specificity and we're reducing sensitivity. Anyone who trades with a lot of sensitivity is going to get really beaten up. And the reason is you're going to pull in a lot of losers. As you slowly define market structure, you're going to wait for the market to give you the specific structure and price action that you want. Like today in the trading room, we had 5 winners and a loser. My first trade was a loser, and it was a costly loser. But then I had 5 E-mini winners in a row. And the reason that I was able to do that was because I had to let a couple of very big moves go past me because they didn't conform to my rules. I didn't get an engulfing candle entry. I didn't get a piercing candle entry. I didn't get a dark cloud cover entry. And there were a lot of other things that I didn't get. But then the last trade, I think, went 13 or 14 ticks. It went almost 4 points, and we got our fifth winner and out. So you have to let a lot of moves go by and not chase the market. You've got to wait for the market to come to you. So if you look at this chart, there's a lot of places you can go short here. Now here's one of them. 2 candles in a row to find a downtrend. Now we always want to trade a retracement. Now let me tell you why you have to be a retracement trader. If you're not, you're going to run into tons of trouble. And I swear you should sleep with this word under your pillow. I really mean it. Because when you trade a retracement, you're looking for the market to reaffirm its direction. When you get this red candle, is there any indicator that's going to guarantee a continuation? Absolutely not. On this red candle, will any indicator guarantee a continuation? There isn't. Same thing with this candle, same thing with this candle. Then buyers step in. Now, we already defined the trend as being down because we've got 2 red candles in a row. So this green candle is a counter trend trade. And we never counter trend trade ever. So we let these buyers come in, and then we look for a reaffirmation of an entry back into the trend. This will give you the safest way of getting into a trade. And this is we're just starting off with market structure and price action. And this is the kind of things that nobody's going to tell you, and you're not going to find in very many books, because the information is so valuable, nobody wants to publish it. And you can see that this just barely is a dark cloud cover. This candle body comes into the green candle halfway. So this is your entry candle short. And although it's going to chop around, your stop is up here, one tick above, and you get a gigantic move to the downside. That's a great place to go short. Now, we have to wait for the market to define a trend. And now I'm gonna remove all the scribbles. Just remember, dark cloud cover, piercing candle, engulfing candle. We're going to look for a retracement in a defined trend, and never counter trend trade. And I'm going to erase it all. Now, here's one red candle. Here's two red candles. It defines a downtrend. We're looking for someone to counter trend trade. And there's the green candle. By our definition of two reds in a row, and that really starts an A candle. After that second red candle, you get an A print on top of this red. You get your retracement, and you get the continuation short on an engulfing candle. Tremendous selling power. You're trapping all the buyers in this counter trend candle. They're all going to get stopped out. Tremendous selling power here, and down you go for another big winner. So this is basically how you trade. Now, here's a very, very powerful signal that fails. Now remember, there are price action fanatics who just play price action and just trade market structure. Now, you're going to see that although this is the nuts and bolts of trading and is really very, very fundamental to trading, you need a little bit more, and what you do need is indicator confirmation, because this is a long candle right here and a long entry. Here's your two greens, and this is a very, very powerful signal. And I hope you'll remember, this is being recorded and you can watch it over if you want to, but this candle engulfs the candle body of the previous two candles. That tells you there's an enormous amount of buying enthusiasm or buying power in this candle. Now, yet it fails. And you're going to see failures if you just trade market structure and price action. But you have to understand this in order to make your trading successful. Now, I'm just going to do one more here. Here's your red. Here's your red. Here's your retracement candle. Here's your engulfer. And you have another winner to the downside. Now, there's one other type of trade that I'm going to mention, and that is, it's sort of a touch of Fibonacci, although I loathe to mention the name. But here's the move to the downside. Here's the move to the upside. The retracement in the trend is close to 70%. Your short is here. It almost comes and stops you out, and down you go. So in answer to the question, where's the best place to sell short on the chart? Let me just click out of the drawing tool. It's right there. Now, I chose to look at the this little retracement right here. And the reason I liked it so much was that you get an engulfing candle at almost a double top and a 90% retracement for a move to the downside. Although I showed you there's a lot of other areas. Now let me remove all the, I got to move faster than this because I have so many slides. Let me go back here. Now, where's the best place to go long? And I know, now the reason that I want to, what I want to do is define another extremely powerful area of market structure setup, and that is consolidation. You can see, whoops, oh my God, I got a magic marker. Hold on a second here. You can see right here that the market is moving sideways. Now, which direction is price most likely to break out of consolidation? It's almost always going to break out in the direction of the trend. Now, the trend is defined right here. Here's one green, here's another green, here's a third green. So that the trend is up. Market moves sideways. Now you know you're going to break to the upside. The question is, where is it going to happen? Now, where it's going to happen is when the market hits support. And the candle, that's your long candle. You can see it's an engulfing candle, and we want our entries to be engulfers. And if we look here, and I get rid of this pen again, there's the best place to enter long, on a break of consolidation with the trend. And you get a beautiful move to the upside. Let's go to the next slide. Now, listen, I want you to understand that this is not exciting, that it's difficult and it can be boring. But the point is, if you don't understand the underlying principles in terms of trading this way, you will not be able to trade with indicators. Now, the best place, in order to make this quick, the best place to go long here and to illustrate another kind of trade is right here. Here's the uptrend. Get the retracement. Here's the entry candle. It's an engulfer, and up you go. You can take it all the way to the top. Now, the principle is a little bit of an Elliott wave principle. Here's the A, here's the B, and the C wave is always the longest wave of the Elliott wave movement. And this is why there's an A here that prints after you get it two candles in a row of the same color. The software prints a B, and then the C flashes because this candle has the potential to engulf. When it engulfs, it prints you're already in. You're looking for a trade one tick above the close of the candle, and you're already in, and up you go. If your stop is tight, you get the retracement. You're in again on another engulfer, and you can get the rest of the move. That's how you trade. Now let's look at another slide. And there's that's the first retracement in an uptrend is always the most powerful. You can take a second retracement, a third is stretching it. We don't take fourth and fifth retracements in a trend. The up candle engulfs the previous down candle, confirms buyers are firmly in control, and up you go. Now, there are three excellent places on the chart to enter long. I'm just going to show you where they are. Here's one. First retracement in the trend. You can see the trend is clearly defined as an uptrend. The retracement, engulfing candle, move up. Second retracement, engulfing candle, up you go. Now you've taken two retracements, and none of this price action is really that great. Now, if you consider, you can always consider this a second move, a retracement, and another move up right here. In fact, you can. What I'm just trying to do right here is just try to show you the best trades, because I don't want to get too complex. Now, here's the next one, and it's a double bottom. You get a move down, and really what I call it is a double test. Now, you don't take this trade floating in the middle of nowhere. This is where you need support. You need a moving average. You need market profile giving you a value area high, a point of control, a value area low. The market comes down and can't break it. It goes up, comes down again, gives you a double test. And the double test or double bottom or double test and double top are strong moves. And the thing that's important is the entry candle here is an engulfing candle. Remember, we only enter on engulfers, dark cloud covers, or piercing candles, and up we go. Now, two best place on this chart to enter the market, right here. Now the software, I let the software run here. You can see that the A is printed because you have two reds in a row. The B is printed because it's a counter trend candle in a downtrend. The C is printed because it's engulfed the counter trend candle. You're in one tick below the C and down you go. Same thing for the uptrend. Two greens in a row define an uptrend, counter trend candle. We never counter trend trade. We would never take that short candle. We're looking for a confirmation of the uptrend, and up you go. And if your stop is if your ATM is liberal enough, you can capture that entire move up, and that's a huge move. Let's keep going. Here we've further defined market structure a little bit by putting in a simple 50, so a 50-period simple moving average, and this is our proprietary 15-period moving average. Now let me just remove the junk, and what we're looking for is the best place to initiate a short and the best place to initiate a long. I give these questions to the people in our trading school all the time. I put the answers are crystal clear. Do you see what they are? Now, if you don't do a lot of studying and a lot of work, it's not so crystal clear, but I'm going to show them to you. Now, let me go back. I don't like that I did this, but here's what I did. It's right here. Let me just go to the pen. You can see that the price breaks the 50, retests the 50. Remember, it's a double test and a double top. And then down it goes. And what I used this slide for was to really emphasize double tops and double bottoms. And let me just get rid of the drawing pen. And then we've got the simple retracement. We have the defined move up. When we get a doji, I've just arbitrarily decided that we can count that as an up candle or a down candle. It doesn't make any difference. The software won't trace out an A, a B, or a C. But here's the move back, confirmation up. Obviously, any candle will engulf it. It's just nice that we've got. Now, we won't take a trade unless a candle body's 4 ticks or greater. That's in our algorithm when we do our algorithmic automatic training. If the candle body doesn't have 4 ticks, we don't trade. It doesn't, because it doesn't show enough buying or selling enthusiasm. So here's a double top, and here's a simple retracement in a confirmed uptrend, and we have 2 winners based on market structure and price action. Now, let me just, again, get rid of the junk. And we're looking for 2 great places to sell the market short. And here they are. If you look carefully, you can see that this is an area of consolidation. Candle bodies are very tight here. And price moves sideways right into resistance. You're going to break out of consolidation to the downside. You're engulfing a doji here, or you can call this a hanging man if you want. And you have a nice big candle body. Down you go. Single candle retracement, dark cloud cover, and down you go again. Single candle retracement, dark cloud cover, and down you go again. This move alone can constitute your entire day. This is $400 or $500 of profit on 3 or 4 contracts right here, just by taking a trade in a confirmed downtrend based on price action and market structure. You've got the modified 15 to help you with consolidation, but really we're trading price action and we're trading market structure. What the 15 and the 50 do is increase specificity even greater. That's all they do. They make the trade conform to our rules to even a higher degree. That is all they do. There are 3 excellent places here to go short. Let's see where they are. Here's one. Now, these are all system-generated signals at a consolidation. I mean, we have indicators that actually assess market structure. And you can see the candle bodies are tight. Intra-candle, you get a triangle. You can see that the candle body pierces, or I'm sorry, it's a dark cloud cover. You're in at the close of the candle to the downside, and you have a winner. And then you have 2 more trades at a consolidation. Dark cloud cover, in and down. Retracement, at a consolidation, dark cloud cover, and down. 3 winners right here. Now, if you didn't understand price action and market structure, you just couldn't get them. Now, you actually have a 4th. It's right here, and I'm sure by now you can see it. I missed it when I created the slide. It's right here. And there's actually one right here, but it may not get to your first target. It's going to come up to here, and then you're going to go down. Then you go up and down, up and down. Or if you're very, very liberal with your risk management, you take the whole trade all the way to the bottom. Either way, now we're trading with specificity, and now we're making the market come to us. And we're trading, and we're real price action traders here. We're not trading indicator confluences. That's the important thing. We've changed our mentality. Now, the best place to sell short, I'm going to skip that. The best place to buy long, again, at a consolidation. Okay, now I think I'm getting redundant. So let me just switch, let me see what time it is. All right, I've got just 10 more minutes, and I'm just going to go to one more. Because here's what I want to show you a little bit of. I want to show you this. Now, here is when we combine market structure with our indicators. Now, remember that market structure will always trump indicators. We look for indicator confirmation, but we don't necessarily must have it. Now, these were all trades I took in the live trading room because we've got 28 ticks and we've got 21. So I took them in the trading room. And I wanted to show you the power of the combination of price action when price action defines the entry and indicators simply confirm an entry that you're already going to take. Now, right here, we have a move to the downside. We know it's a downtrend. We know we're getting a retracement. We know that the continuation short is just a dark cloud cover. Now, usually we want to take these right off a resistance, but I gave this trade a little bit of leeway. I didn't have background bias, which means I didn't have multi-time frame alignment, didn't have the quant lines, which means our correlative markets were not with us. But this was just such a powerful market structure setup. I took the trade short and it went 28. Then we had the conservative trend trade. We moved back to resistance. We know that we're in a downtrend because we haven't had two green candles in a row. We've had a green, a red, a green, and a red. No single green changes the direction from down to up. So we're still in a confirmed downtrend. We hit resistance. The candles surrounded in red. It tells us that we have order flow and momentum to the downside on multiple time frames. We know that the 50 is down. We know that the modified 15 is down. And here we have the correlative markets down. We're in one tick below, and down we go. This is the perfect amalgam of an entry via perfect market structure and price action combined with indicator confirmation that we're going to get a win. And the trade went 21 ticks. This is where you want to be. Now here's the next trade. I did exactly the same thing, and here's the thing about these patterns. They keep recurring over and over and over again. And once you get them down, they're gonna start popping in your face. Now, here's the top. You can see I drew it in blue. We had the move down. We had the move up. The trend is down. Confirmation. We have the retracement. And the move went down 8 ticks. And remember, the entry again is an engulfing candle. That's what we look for. Then we had the move up. Now, this is a move back up. Even though these two green, we call this a multi-candle retracement. But the overall trend is still to the upside. And this is where we combine the modified 15 and we extend ourselves out a little bit more than just market structure. Remember I said that if you just trade market structure alone, you're not going to have enough percentage of winners in order to become profitable. When you combine indicators with market structure, that's where you really start to make money. Now, if you look at this trade to the upside, it's got a dual area support, the modified 15 and the point of control. and the overall trend is up. And we went up 21 ticks. I'm just going to show you one more slide, and then I'll take questions, because I know this is a lot. And it takes a long time to master this. But if you don't master this, I'm telling you, you can't make money. Let me show you a little easier one than this. See, here's a nice trend trade that you just you can stay with. You just don't let go of it. And once you see this happen, you sort of grab this by the throat and you milk it for everything it's worth. Because this can be an area that takes you out for the day. Now, I could have taken the C candle. I didn't. I waited for the green candles, the counter trend candle. We went down for 7, came back, retraced to resistance. We came down for 5, came back, retraced to resistance. This is a dark cloud cover. This is an engulfing candle. This is an engulfing candle. The overall trend is now defined by the modified 15. We've given up a little bit of price action to a better determiner, a better way of determining trend. And this one, we get 28. So you get 7, 5, and 28. And you milk this trade, you're done. And here we have indicator confirmation. The quant line is with us all the way on the trade. That's that red line. We've got our order flow and momentum with us here. We've got the trend and a retracement and the quant line here. And here, and throughout every trade, we have background bias, which tells us that the market is aligned to the downside, the 50 and the 15 on our 2 higher time frames. So we are sure via the use of indicators to confirm what we know via market structure that we are trading in the trend. And everyone taking an up candle here is counter trend trading. And we're going to run these people over and beat them up. We'll look at one more, and then I'll take questions. And this is a trading methodology. Now here's an up move. Again, these trades were taken in the trading room. And you've got the move up, the retracement, and this one almost stopped us out, went up for 5. We went after it again, and this one, we went up all the way for 30 ticks. And that's enough to finish your day right there. Once you see this background go green, you know that you have all resistance to the upside broken. Resistance to the upside broken. You know that all your higher time frames are moving to the upside, 15 and 50, and you're just going to sail. And up we went. So this is really the way to trade. The first thing that you have to do, the nuts and bolts of trading, are learn market structure and price action. Later on, you don't have to trade our indicators. But if you don't learn the nuts and bolts, which is price action and market structure, if you don't learn how to look for setups, double tops, double bottoms, tweezer formations, engulfing candles, piercing candles, dark cloud covers. Now, there are many, many other candlestick formations, which I didn't get into, and we don't use because the predictive value of those formations are low. They give you some information about market sentiment, but not enough to give you an entry trigger. And if we can't get an entry trigger and increase precision with a candlestick formation, then we're not even going to bother with it. We're only going to bother with the entries that provide us with a nice entry and get us more wins and decrease the number of losers. And the key, as I've given, in every webinar I give, is it's never about the number of winners. It's always about the number of losers. The most losers we take in the last 6 sessions is 1. Most of those sessions we had none. And that is why we trade profitably, because we wait and trade with tremendous specificity. You cannot trade with specificity if you take indicator entries. They will not work for you. And learning market structure and price action is laborious. It's boring. It's tedious. It takes time and practice. But that's why only 5% of day traders make money. The ones that just want to take the easy route, which is wait until all the lines turn green and take a long, and all the lines turn red and take a short, are the ones that are going to bust out. And you have to understand how each variable interacts with price and movement, and combines to give you a sensitivity, specificity, and then you look for prevalence. Remember, since we only trend trade and we define the trend with the 50 and the 15 up, the prevalence of a good move is high. And sensitivity over specificity times prevalence gives us the positive predictive value. If we trade in the trend, we know that the prevalence of a good long move in an uptrend and a good short move in a downtrend, the prevalence is high. So I'm going to stop there. Let me just quickly give you the last slide, and then I'll take a few questions. And if I can find it. Now, if you want to sign up for the trading school, it's $39.99. And it's a lot of work for me and for you. And for the first 2 people, I put in for 4 months. What we're going to give you is, we'll give you the live trading room for 1 year. That's a lot of money. So you'll be in our live trading room. And the live trading room where I take the trades is very, very lucrative. And I wasn't going to do it, but I'm going to show you our 5 trades from today. Let me drop this really quickly. And then I'll still answer questions. Okay, now this is the ES. Okay, here's the ES, and I'll show you our 5 trade. We had 5 winners on ES, and I'll show you my loser. And we were done around 10:15, so the trades are going to come early. You can see I took 2 trades right here. I took the move down. We're in a confirmed downtrend. You can see that we're trading at a consolidation. Price action is perfect. We've got indicator confirmation, and we went down for 4 ticks. Not a big trade. I did the same thing here, down for 3. Our first target is 3, second target 4, third target 11. These were small trades, but we had triple quants, which is very powerful, and we had perfect market structure arrangement. We caught all these people in the counter trend candle, all these people in the counter trend candle. Everything that I told you in terms of price action, trading out of consolidation in the direction of the trend is operational. I couldn't get these moves up. These trades were too far off support. This trade was too far off support, and this huge move up, I just had to sit and let it go. Then I waited for the retracement. It was multi-candle, but I let it come. This candle, whoops, I can't get this thing pierced. Was a piercing candle to the previous candle. On up it went for 8, 2 points. That was a third winner. Then I took a retracement. in a confirmed downtrend, and we went down for a point and a quarter, and then I finally got my big trade, 14 ticks, which is 3.5 points. The move down, the move up, I took it here. Now, it actually went into consolidation and came one tick from stopping me out, so I didn't take the more conservative entry, but then it went down for 14 for 3.5 points. Those were our last 5 trades, 5 winners on the E-mini. And I had one loser on crude, if we can show that really quickly. I don't want you to think that all I take are winners, because I don't. And here was our loser. It was the first trade I took. And it's always great when the first trade of the day is a loser. And I was going through some of the form right here. I took a double top, just like I said. Here it was. The move down. We tested the 15. It failed. My expectation was that we would fall. I did not have indicator confirmation, but I thought that market structure would trump the indicators. They did not in this particular case, and we had a loser. So I had 5 winners and I had 1 loser. But you can see how I based the entry on market structure. The break, retest, move down, didn't happen. So let me see if we have any questions. And I'll try to answer as many as I can. Okay, we don't have that many questions. All right, hold on one second, Adam. Let me just go to the top here. The time frame of the chart, Brad, is an 8 range. Adam, it doesn't make any difference. Adam asks, what is the best time frame using candle structure? It's irrelevant. I mean, this candle structure, price action, and this kind of structure does not make any difference whether you use an 8 range, a 3 range, a 5 range, a 377 tick, a 2-minute. It transcends all of that. Doesn't make any difference. The ones I'm showing are 8 range, Payman. Open interest and volume are very important. This isn't really about options, but we trade options, but I'll just tell you really quickly, they're very important. Open interest and volume tells you how easy it is to get in and out of the option, and it also determines the spread. Options are very, very tough to trade. A lot of people trade them, but very, very few people trade them profitably. And if you get yourself into a thinly traded option with only a small amount of open interest, what you're going to do is when you try to get out of the option, even if you're profitable, you may give up 5% or more of your profit and just trying to get out. So you want to trade an option that has a very, very large, an open interest and volume are usually correlated. If there's a big open interest, volume is usually high. So that you want to stay with the options that are very, very, very heavily traded. Yeah, we will send the webinar out. A tick, Adam, is defined as the smallest incremental movement in an instrument. So a tick actually in stocks is a penny. A tick on futures is a tick is the smallest movement. Now what a tick is worth depends on the market. In crude oil, a tick is $10. In the E-mini, a tick is $12.50. In the NASDAQ, a tick is $5. And the number of ticks in a point is also variable. But the tick is the smallest increment that an instrument can move. The quant lines, Larry, are very important. What we did was, and this is what makes trading the ES so great, and why we have such a huge percentage of winners on the ES, is each quant line consists of 3 correlative markets. So there are 9 markets on the ES, and they correlate with a correlation coefficient of 0.7 or greater. So if the ES is dropping, the markets that are giving you the red should either drop with the ES or rise with the ES. If they do, they're moving in a direction. In other words, the markets that fall are the ones in which money flows out of, and the markets that rise when the ES falls are the markets that money flow into. And to give you a good example, if the ES falls, the Russell has a high correlation coefficient. The Russell's likely to go down, and the Russell's one of the components of the quants. Bonds and notes are likely to rise. And so they're a component of the quants in the opposite direction. So we're looking for the correlative markets, and really all the quants are is a footprint of money flow. We want, I mean, and all that institutional traders do all day is rotate their money. They really put very little to work in cash. What they do is they move them from precious metals to currencies to agricultural products like corn, soybeans, and wheat. If I said precious metals, I'll be redundant. They move it to bonds and notes. They move it, and then they move it to stocks. It's a risk-on, risk-off environment. When risk is on, they're in equities. When risk is off, they move their money. And what the quant lines do is follow the money. And when you have 3 red quant lines on the ES, money is flowing out of all the markets that it should flow out of to suck the ES down and moving into the markets to also pull the ES down. So when you have 3 red lines and a perfect market structure price action setup, you're very likely to get a winner. And that's one of the reasons why I could pull 5 in a row. Our track record now on the ES is getting enormously high because I use those quant lines. Now, you can't trade them. You can't go red, red, red and take a short. You can't go green, green, green and take a long. But when price action and market structure are set up and you look down and you have green, 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 and red, 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 great chance of getting a winner. You know, Larry, we don't have a specific volume-based indicator, but if you look in the lower corner of what we do is, what we have is we have, and it's sort of unique because let me show it to you here. You can only see it on the right edge, and hopefully you can see it right now. Actually move that out of the way. You see that red, it's not red, that orange? That's the number of contracts crossing per minute. And that's on a range chart. And the purple or the magenta behind it is the average number of contracts per minute. And I watch that carefully. And I know that on crude, I want to see at least 300 to 400 contracts crossing per minute. I know on the E-mini, I want to see, at least a couple thousand. So I watch volume very carefully, although we don't have an indicator specifically. And what we're going to do eventually when we have the time is we're going to create an odometer, and it's going to be calibrated for each market. And it's going to be yellow. It's going to be for caution, red for caution, yellow, and then green for when there's great volume associated with each move. And we can take it right off of the minute volume. When minute volume is really moving, it's the best time to take a trade. It's a good question because volume is really important. The reason I don't trade the Forex simply because of the time. It's just it's in the middle of the night. I don't trade the Forex European session. That's the only reason. It moves exactly like these markets do here. And if I had my Forex data feed on, I would rotate this market to the Forex, and I would show it to you. But the thing is that I don't have the Forex hooked up, so I can't show it to you. But Forex moves exactly the same. Remember, price action, market structure, they're all independent of instrument, all independent of time frame, all independent of formation, whether it's a candle, open, high, low, close, it doesn't matter. Whether you're trading a 377 tick, whether you're trading a 244 tick or a 144 tick, it's a 2-minute, 4-minute, 6-minute bars, it's irrelevant. And the reason we don't use triple quants, Brad, is because on crude, we can't find 9 correlative markets. We can only find 3. On the index equities like the E-mini, the Russell, the NASDAQ, and the Dow, we've got 9 correlative markets. On bonds and notes, we've got 6. So we have 2 quant lines. So the number of quant lines we have depends on the number of correlative markets we could find. And if we just can't find a correlative market, we just can't add another quant line. We can stick 3 markets in each quant line to give you a total of 9 markets on 3 quants, 6 markets on 2 quants, 3 markets on 1 quant. And if the markets aren't there, we just can't add the quant. And that's the reason. The more quants, the better off you are. And that's what makes trading the ES bonds, notes, and any of the other index equities so good, is because the quant lines are so powerful. They really, really help confirm a trade. But again, price action is the driver. I would avoid anything, Sajad, that doesn't have enough open interest or volume when it comes to options. If the option is in a liquid, listen, you don't only want to trade a liquid instrument. If it's in a liquid instrument, here's the thing. If it's in a liquid instrument, the market makers are going to play with you. And they're going to move the bid and ask around because no one's trading it. And when you go to get into the trade, they're going to strafe you. And when you go to get out of the trade, they're going to strafe you again. They're going to make you pay the highest price they can. When you get in, they're going to try to make you as close to the ask as possible. When you get out, they're going to try to give you a price as close to the bid. And when the markets are liquid, believe me, they're going to do it. And they can take a nice slice of your profit. So only trade options that are very, very liquid. And let me tell you, I learned that the hard way. It looks like you're up 70%, 80% on an option, then try to get out of it. And then you find out you're only up 50% because you lose 20% just getting out. So don't trade anything with a small open interest and small volume. You're going to wind up having a problem. The background bias, Larry, is based on the 2 higher time frames. And I don't want to make this too long, but when you have pink to the downside, all supports broken, 15 and 50 on the 2 higher time frames are to the downside. When you have the dark green, all resistance to the upside is broken, 15 and 50 are to the upside on the 2 higher time frames. On a range, we use the 2 higher fib numbers. For a 5 range, we use the 8 and the 13. For the 8 range, we use the 13 and the 21. If you're trading a time chart, we do the 3 higher time frames. So if you're trading a 2-minute, we're going to trade the 6-minute. We're going to look at the 6-minute, and we're going to look at the 18-minute to determine the 2 higher time frames. If you're trading ticks, we're going to look at the 2 higher fib numbers. Now, obviously, they're intermediate colors, but I'm not going to go into those because it takes a little work on those. But the green's the strongest to the up, and the pink is strongest to the down, this dark pink. This is what you really look for. When you get this background bias with these quant lines together, and you get a great entry based on market structure, the positive predictive value of a winning trade on the ES, I'd say is greater than 85%. I think it's closer to 90%. You just have to be patient and wait for the trades to occur. And I know, and I will tell you, that quant line number 1 is the major quant. It's got the most powerful markets and the ones that correlate the most. I want that line with me. Line number 2 is a little bit weaker, and I'll trade without quant line number 3. But I want one, definitely one. I would love to have 2. And if 3 is with me, it's even better. And these are all the things that we teach in the trading school. At the end, we go into the indicators. Now, a lot of time is spent looking at price action and market structure, because this is where your trading skill is made or broken. And this is where you become a profitable trader, or you're not going to make it as a profitable trader if you understand how to trade price action, market structure, and learn how to take these entries. Look for the dark cloud covers, look for the appropriate retracements, look for the appropriate formations. There are a lot of formations I didn't go into, but because I can't do it all in one session. But this is where you're made or broken. And this is where you become a professional, profitable day trader. And when you hear about these sites that say, come on, you'll trade for 20 minutes at 10 minutes in the morning and you'll make $100,000 a year, forget it. It's not going to happen. It's a hard job, but at least we give you the path and we give you the tools. And everybody who takes this class graduates a really good trader because they're very motivated. And they do tons of homework. They send me 1 million JPEGs, and I verify them, I critique them, I send them back. I do a lot of work myself on making sure that everyone's up to speed. So it's a big job for everybody, but that's what we want to do. We want to make you profitable, and for the first 2 people who sign up, we'll put you in the room for a year in the trading room, and that's a tremendous augmentation to it. Because you're going to be able to trade over my shoulder. So that's a big plus. I try to pride myself on taking good trades, although I don't always take great trades, I take good trades 95% of the time. And you can just take my trades, and each trade at the end of the session, I go into and recap why they were taken, what was my rationale. Some of the most frequent questions I get are not why I took the trades I took, but why I passed up entries that I didn't take. Occasionally I miss an entry, but that's usually where you learn the most. It's where you learn why I saw an entry and why I didn't like it and why I passed it by. Whether it's a winner or a loser, I'll tell you, when you're on the right edge of the chart like this, and you have to determine right here whether you want to take that candle long, that's the toughest place to be in the world as far as I'm concerned. So I like to look back and see, and see how I gauged it, but it's a very, very tough place to be. So John, don't worry about that. We'll format that all for you. And it's really, that's all in terms of colors, that's all formatted by us. In terms of the software, we do it for you soup to nuts. We download it, we configure it. Don't even worry about that. That's not even an issue that you have to address. We'll get, we have Leo here. The guy's like a genius programmer, and he will get all of that flowing for you perfectly. So listen, that's it. If you have any questions, give us a call. I'll show you my last slide. It's just our address. Let me just drag it over here. No problem. Let me just, oh my God, the slides are all disappearing. 1 second. It's just, we're www.rightlinetrading.com, and I think I just blew the screen. Okay, here it is. Let me find it. Here we are. We're at www.rightlinetrading.com. You can email us at info at rightlinetrading.com. You can call us at 1-855-765-6681. So I really appreciate everybody coming this evening. I hope I conveyed to you, some useful information. No matter what you're doing, be very, very careful with indicators. They're good, but they're not very good. Price action and market structure drive. And I didn't want to get into the fact that taking indicator analysis from the price, from price of their trading charts, very poor way to use indicators. All our indicators assimilate data from the higher time frames and actually give you look ahead value. That's another webinar. But we're at www.rightlinetrading.com, 855-765-6681. There'll be a recording of this, and we'll send it out. Everybody have a great evening, and thank you so much for attending. I really, really appreciate it. Bye-bye.